Hello viewers, and welcome to part 2 of our screencast entitled Estate Settlement and Trust Administration in Connecticut. My name is Richard Land. I'm an attorney and I'm a member of a Danbury, Connecticut law firm known as Chipman, Mizuko, Land & Pinerola, or we shorten it to Chipman Mizuko. In part 1, we covered what a will or a last will and testament is, the job description of the executor of the will, the different people, that's the beneficiaries, creditors, and tax authorities who are interested in your will and in your estate. We covered the definition of the word estate, the reasons for the probate process, the application to start the probate process, and the duty of the executor or the administrator to find the decedent's assets and prepare the estate inventory. Then, as part 1 came to an end, we were talking about how important it is for the executor early on, that's soon after the decedent's death, to identify the important issues and decisions that the executor or the administrator must make. That is when we mentioned that one of the first things we do is to review all the early facts we have and prepare a letter to the executor and administrator, which we call the estate settlement letter. The estate settlement letter describes in detail the issues and decisions the executor or administrator must face. The goal is to identify important issues early, before it's too late to do anything about them. And always keep in mind that as executor or administrator, you may be held personally responsible if you fail to identify and deal with the issues, and if your failure reduces what the interested parties would otherwise be entitled to from the estate. Here's a sample of the type of letter we typically prepare. In the letter, we try to identify all the important steps that the executor or the administrator will have to face during the course of estate settlement. We typically include a checklist published by the Connecticut Bar Association of pretty much every conceivable step that an executor or administrator might need to face when settling an estate. It's a little dated, but it's so good, we use it anyway. We go through the list and we highlight the steps that we believe will apply to the particular case. In any event, whether it's done through the estate settlement letter, like we do, or in some other way, it is important to try to identify issues early and come up with a plan for dealing with them. This is often referred to as postmortem planning. So, in the process of postmortem planning, we try to address as best we can at this early stage the cash needs of the estate. We try to address any legal issues, such as the proper interpretation of the will or legal claims that might be made against the estate. And we try to identify tax issues, all the different kinds of tax issues which might affect the settlement of the estate. And we address accounting requirements. Let me try to give you some examples of the types of issues that should be addressed at this stage. Real estate can be tricky and a variety of problems can come up. For example, we had a situation where a decedent's will included a specific gift of his home to his friend, call him George. I've changed the names here. And the property was subject to a mortgage. Everything else went to Alice. The executor did not understand that from the date of death, title in the property had passed to George, and George, not the estate, became responsible for the mortgage payments and the real estate taxes and expenses related to the property from the moment of death. So the executor paid the mortgage installments and other real estate expenses during the course of estate settlement. The executor also made distributions to Alice without taking care of tax obligations. Unfortunately, there were significant tax obligations, and when the IRS demanded what was owed, there was no cash in the estate to satisfy them. Alice had spent all the money that had been distributed to her, so the executor could not get it back. And when the executor tried to recover from George, he discovered that George had no money. The value of the property had declined dramatically when the real estate bubble broke, and the property was in foreclosure. It had a bad ending for the executor. He had to satisfy the tax obligations, including hefty interest and penalties, from his own assets. This is an example of the types of problems an executor can get into if he's not aware from the beginning, if he's not aware of the relative rights and responsibilities of the parties, of the beneficiaries under the will, and of the creditors. If the executor had sought legal advice early in the process, all the mistakes he made could have been avoided. So it's important for an executor to understand how real estate is handled during estate settlement. In the situation I just mentioned, the property was the subject of a specific gift. The result would have been much different if the property had been just another asset in the estate, which was not identified specifically. When an executor or administrator deals with real estate in the decedent's estate, he needs to be aware of many things that may affect how it should be handled. Is the property contaminated? Is the contaminating activity ongoing? Could the executor be personally liable for the cleanup involved? Is the property subject to a mortgage? Does the will provide for the payment of the mortgage? Is there any equity in the property? Will the lender be making a claim against the estate for any deficiency? And of course, there is the possibility of tax liens, some of which may be effective even though not recorded on the land records. And it's important for the executor to know precisely what the decedent owned at the time of death. Often there are complicated title issues that, unless addressed early, may not be discovered until the beneficiaries try to sell the property many years later. It makes sense to try to identify these types of issues shortly after the decedent's death. The tangible personal property, things like tables and chairs, automobiles and tools, can be difficult. What should the executor do when the decedent's surviving housemate continues to live in the decedent's home and is possession of all the decedent's tangible personal property, much of which is given to someone else? What does the executor do when the housemate claims ownership of many of the items the other beneficiary claims? What should the executor do to properly protect those items that are in the possession of the housemate? There are no standard or cookie-cutter answers to such questions. The proper treatment will depend on the terms of the will, the personalities of the parties involved, and the backstory. It's important, however, in any case, to identify the issues and think about the proper way to address them early on. Let's talk about income taxes. It seems that there is always some income tax issue to consider, and keep in mind that the decedent's income tax obligation can become the personal obligation of the executor if not satisfied properly from the estate. The decedent's final individual returns, both state and federal, must be filed by the executor. And assuming income will be generated by the estate assets, the estate's income tax returns, they're called fiduciary income tax returns, must be prepared and filed by the executor. And there are a host of tax elections that an executor or administrator needs to know about, some of which you see here. If the executor or administrator fails to consider a tax election and, as a result, the beneficiary receives less than he otherwise would, the executor might be personally liable. All these elections are time sensitive and should be identified and considered early in the estate settlement process. And Congress continues to add new elections. The latest, most important one was added in January 2013 in the American Taxpayer Relief Act, which is commonly referred to as ATRA. It's a new election whereby the deceased spouse's unused estate tax exemption can be passed to the surviving spouse. That's called Exemption Portability. To take advantage of that election, the federal estate tax return must be filed for the decedent's estate even though the estate is well below the $5,250,000 threshold for filing a return. For more information on the Exemption Portability election that I just talked about or referred to, you may want to look at Part 4 of our YouTube video entitled Basic Estate Planning After ATRA. We just covered income tax issues and different elections an executor needs to think about, and then I switched gears and I started talking about exemption portability, which is really an estate tax election. So let's stay with estate tax issues and talk about them for a while. Remember once again that the executor or administrator may be held personally liable for the failure to satisfy estate tax obligations. And once again, the deadlines for filing the returns and paying any tax make this a time-sensitive topic. The federal estate tax return and payment of any tax is due 9 months after death. The Connecticut estate tax return and the payment of any Connecticut estate tax is due 6 months after death. The executor can get extensions to file, but that is not true for payment. Extensions for payment are available only in exceptional cases. Let's take a look at how these tax calculations are made. But for more on this, I suggest that you take a look at our YouTube video entitled Basic Estate Planning After ATRA. You can see that the federal estate tax exemption is now $5,250,000, so that, for now, only the wealthy need to be concerned with the federal estate tax. And once you get above the exemption, the tax bracket that applies is 40%. The most recent administration proposal, however, is to reduce the exemption to $3,500,000, so perhaps we need to remember that the rules seem to be constantly changing. That's one reason why postmortem planning can be so important, to take into account all the changes that occur. For planning purposes, keep in mind that if there is a federal tax, arrangements need to be made to pay it by the due date, which is 9 months after the date of death. For Connecticut estate tax purposes, the exemption is $2 million. Here are some examples of what the tax would be for different estate sizes. So you can see that there is no tax when the size of the estate is $2 million. When the estate is $2,500,000, the tax is $36,000. At $5 million, the tax is $230,000, and so on. For you to really know what this means, you need to know what gets counted when you're trying to figure out the size of your estate for tax purposes. It's not just the probate property, it's also the life insurance if you are the insured and have any ownership interest. It includes jointly owned property and the trust accounts you might own at your bank for which you've named a beneficiary. It includes IRAs and similar retirement accounts and death benefits under annuity contracts that you own. You can think of it this way. It includes pretty much any asset that may pass to someone else as the result of your death. That's an overstatement and not entirely true, but it doesn't hurt for you to think about it that way. After you add all the assets up, in computing the tax, you need to take into account quite a few estate tax elections. In some cases, the executor can elect to use alternate valuation rules instead of using date of death values. Some assets, such as certain farm and business assets, are eligible for special valuations. Elections exist relating to the deductibility of estate tax expenses as well. And then there might be special elections that relate to property that passes to a trust for a surviving spouse. These are elections that are frequently referred to as Q-tip elections. And there is a special kind of Q-tip election that relates to generation skipping taxes. And we haven't even talked about generation skipping taxes yet. There are a number of decisions an executor or administrator might have to make regarding the allocation of GST or generation skipping tax exemptions. And there are special elections that relate to property that passes to a surviving spouse who is not a U.S. citizen. For decedents who own stock in a closely held business, it's important to pay close attention to income tax rules that apply if a corporation buys back the decedent's stock. And a lot of very important postmortem planning can be done with disclaimers. That's when a beneficiary refuses to accept an inheritance. It's fair to say that postmortem planning that makes use of disclaimers have saved surviving family members millions and millions of dollars in estate taxes. There's not enough time to list all the elections and planning opportunities that might exist, or all the little and big tax traps that an executor or an administrator may have to face. And it's certainly true that the larger federal estate tax exemptions that we have now may make some of these estate tax planning decisions less crucial for most people. But keep in mind that the elections and postmortem planning decisions can be very important for income tax purposes and for Connecticut estate tax purposes, and in situations where estate tax laws from other states apply for those estate tax purposes as well. That's the end of part 2 of this screencast. Part 3 will describe how estate settlement is concluded with an accounting, and it will also include a discussion of the costs and expenses relating to estate settlement that you can expect to incur. Thank you.